Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Verdon in London, and these are the stories that set your agenda. Rate cut optimism. Stocks and bonds gain as weaker than expected US jobs data cements bets that the Fed will ease policy later this month. But a sell-off in China intensifies on reports of a crackdown on speculation. Elsewhere, Ukraine's president joined European leaders in Paris as Vladimir Putin says that a meeting with Volodymyr Zelenskiy should take place in Moscow. Plus, Apple shares jumped the most in a month after we report it's planning its own AI-powered web search to be launched next year. Well, the bad economic news was good news for these markets yesterday. Stocks and bonds rallying off the back of that JOLTS data, the prelude to the payrolls numbers that we'll get tomorrow, of course. And that mood continuing in the Asia session now. We're up 0.2% on the MSCI Asia Pacific Index. But as I say, pairing some of the earlier gains because of the sell-off in China. We'll get more on that in just a moment. But futures pointing higher on both sides of the Atlantic. Flip the board over to the cross-asset picture. And if we look at your Treasury space, of course, we'd had the 30-year Treasury yield flirting with that 5% level, coming away a little from that now. We heard from the Bank of England Governor Andrew Bailey yesterday, a bit more hawkish than normal. And we had the pound higher, but pairing some of those gains now at 134. Brent on the back foot for another day today at $67 a barrel. Worries about more of a supply glut if OPEC Plus boosts supply again. And then we have gold here, still around the record high, but coming off a bit. It's all back, though, of course, to that Fed cut optimism. Now, let's take a look at what's happening in Asia markets. We can go to our MLive strategist, Mary Nicola, for that. And, Mary, as I say, here's a problem to report. We've got Chinese regulators looking at measures to cool stocks from their decade high. But is the mere threat of speculation curbs enough to control the froth?
I think for now, that's exactly what's happening, and that's the reaction that we're seeing in the markets today. So the markets have pulled back as a result of that announcement. But I think it's important to put it into context in terms of margin financing was rising, and there were concerns about a liquidity-driven rally and potential bubbles. So you can see how policymakers were getting concerned, but it really just does come down to what sort of measures they are planning in terms of trying to mitigate the rally, because there is still a lot of underlying fundamentals that are supportive for Chinese equities. For example, you still have the AI story that's really strong. If we look at earnings, they were a bit mixed, but it still leaned heavily towards the support for AI. And then, of course, you have policy initiatives that are expected to support consumption. So there are still some underlying support for Chinese equities, but it's just about ensuring that it doesn't go too far, too fast, and creating those bubbles and creating some concern.
All right, and let's also talk about that Japanese bond auction this morning. Doesn't seem like there was any drama, Mary.
Yeah, no drama today, and it went off pretty smoothly. But I think that's really not the end of what we're going to see for Japanese bonds in terms of any pain that they're likely to see. Because if you look at it, tomorrow they've got labor earnings, and that's expected to be a little bit more on the hotter side. Which, and then if it means that the BOJ doesn't do anything and isn't hiking, that adds to the stagflationary risks. And then, of course, you have next week a lot of the political tensions coming through with the LDP potentially calling for an election for a new leadership. So there's still a lot of hurdles that the Japanese bond market that will have to get through. And then, of course, you have the broader implications from what's happening globally, which leaves Japan in a very sensitive mood. And, of course, we see that with the yen, for example. The yen isn't following the trajectory of where rates are going in terms of dollar yen, and you can see that it remains a little bit elevated, and it's not following because of that political risk premium that's coming through, and that's weighing on dollar yen, and it's going to continue to weigh on bonds as well.
Yeah, the yen at 148 per dollar right now. MLive market strategist Mary Nicola, we thank you so much. Now, staying in the bond space, bearish bets on Treasuries are growing, raising the stakes around tomorrow's key US employment report. The Fed's Alberto Musalem has signalled that he thinks current policy is in a good place.
The current modestly restrictive setting of the policy rate is consistent with today's full employment labor market and core inflation nearly 1 percentage point above the Fed's 2% target. Looking ahead, I expect the labor market to gradually cool and remain near full employment, with risks tilted to the downside.
Now, of course, that's not the tone of all FOMC members. Let's bring in Bloomberg's Valerie Teitel for more. Val, we had yesterday's jobs data confirming the labour market slowdown in many's minds. Could tomorrow's payrolls data open the door for a 50 basis point rate cut?
Well, definitely, if we get a print weak enough, we might start to hear that kind of speculation ahead of the inflation report next week. But it really was that weak JOLTS data that spurred this bond rally. Yesterday, we had those 30-year yields coming a whisker away from 5%. We're now trading below 490 on the 30-year yield. When it came to those JOLTS data yesterday, surprisingly weak, especially when it came to layoffs. And many commentators pointing to the fact that construction layoffs were particularly acute, many saying that that is a leading indicator. This plays into the thought that labor demand is cooling and may be cooling quite rapidly. You combine that with the Fed's beige book, Lizzie, also out yesterday, that showed little or no economic activity pickup in the previous month, and this plays right into Fed Governor Waller's hands. He was out on CNBC yesterday. This is the main dissenter against holding rates steady, saying he favors multiple rate cuts in the month ahead and gave more warnings on the labor market, saying you want to get ahead of the labor market cooling, because usually when the labor market turns, it turns bad fast in a non-linear fashion. Now, we might get some more dovish speak today from potential Fed candidate. We do hear from Stephen Myron. He is having his Senate confirmation hearing today, likely to press the fact that Trump's policies net are deflationary, and the Fed should continue to be cutting interest rates. But Lizzie, here in the UK and across Europe, this bond market rally really had a lot of impact on the UK. You can say maybe the bond market rally was even led by the UK yesterday. We had those 30-year yields down by 9 basis points in the gilt market. Also saw some pretty substantial rallies when it came to long-end EGBs across France and Italy. But take a look at the 3-day chart when it comes to those gilts. We've all but erased the backup in yields that we've seen. We're now trading flat since the beginning of the week. How surprising how quickly this market can turn around.
Exactly, Valerie Teitel, we thank you so much. Will you take me to European fixed income? Let's go there now. Bank of England Governor Andrew Bailey playing down the importance of a surge in long-dated gilt yields, saying that he wouldn't exaggerate the significance of those 30-year gilt moves. Now, he's also cast doubt on a rate cut later on this year.
Although I think that the path will continue to be downwards gradually over time because policy is still restrictive, there is now considerably more doubt about exactly when and how quickly we can make those further steps.
Let's walk through all this with Kit Rees, editor of Bloomberg's Markets Today live blog, and she joins me this early morning. Good morning, Kit. I mean, we're listening to Bailey there, casting more doubt on a November rate cut. How hawkish, though, is the rest of the MPC?
Yes, so some of the most interesting comments were some of the more hawkish members, like Deputy Governor Claire Lombardelli.
Outing herself as a hawk.
Yeah, exactly, and also Megan Green. So they're very concerned about inflation. Inflation has been very persistent, and this is one of the main concerns of the Bank of England. Obviously, they don't want to impact growth, so they're trying to balance this in terms of the rate-cutting agenda. So Lombardelli said that rates may need to settle only below 4%, which is where they currently are at. So the market's been pairing bets on a November rate cut, and this basically kind of confirmed the market's thinking. This is also interesting given the revote. We saw the historic revote at the August rate cut, so it shows that there's a little bit of dissent, a little bit of caution, and we're probably going to have to wait for more data to see how their thinking is going to evolve going forward.
Yeah, of course, she was one of the dissenters in that vote split, voting for a hold. But also, if we turn turn to the fiscal, the drama there happening as well, of course, feeding into these yield moves. We now know that the budget's going to be on November the 26th, and I've got to wonder, why has the government pushed it out so late when you've got these yields so high and all the speculation ever since spring about what the tax rises would be?
Yes, it's a great question, and I guess it's because there's just still so much doubt about the economic backdrop, the picture in the UK. So we've had lots of very mixed data. Inflation is persistent, and yet growth seems to be a little bit lackluster. The labour market is also a big focus. First, we saw weakness, then we've seen it stabilising. This is, of course, not helped by issues over data quality from the ONS, which it has admitted. So taking all this into account, the government's probably wanting to see how the picture evolves. Throw into the mix tariffs, and there's still a lot of uncertainty over how this is going to impact companies and also filtering down to individuals. So they may just want to be seeing, how the picture evolves, get a little bit more certainty, and also get past certain risk events like the Bank of England meetings, like the Fed meetings, all of those kind of things. So that's why it's a little bit later in the year.
Well, here's another risk they may not have seen coming. You've got the Deputy Prime Minister, Angela Rayner, now fighting for her political life, having admitted, of course, that she's underpaid property taxes. How much is that political uncertainty going to cause concern for markets?
Yes, so markets don't like uncertainty at all. At the moment, we haven't really seen this play out in the market so much. The big focus, as we've covered, has been on the 30-year yield at 1998 highs. This is very concerning, of course. And if we looked over the summer, markets have been in a bit of a lull. The FTSE 100's been at a record. Sterling has been quite strong. So far, we're not seeing that play out. But if we do see any further questions over leadership, any further developments from this probe, we could see some moves. But at the moment, the focus for markets is very much on the fiscal backdrop and on monetary policy, and those are probably going to dominate for the time being, at least.
All right, Kit Rees, so much to be watching here in the UK. That's Kit Rees, editor of Bloomberg's Markets Today live blog, which, of course, is across all of those threads, joining the dots for us. I highly recommend you look at it. TLIV Go is where to find it on your terminal. We've got plenty coming up on the docket today. Let me walk you through it. We've got at 7:30 a.m. London time, Swiss inflation numbers dropping, expected to have stalled in August. Then at 1:30 p.m. London time, as Val was mentioning, we get those US jobless claims adding to the JOLTS data yesterday in the drumbeat up to the payrolls report tomorrow. And then at 3 p.m. London time, we get US ISM services numbers. They're expected to have expanded at about the same pace as July. But you can get a roundup of all the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can find that at DAYB Go. But coming up on this programme, Russian President Vladimir Putin says that President Zelensky should meet him in Moscow as Ukraine's top allies prepare for a security summit in Paris. We'll bring you all the details next. Plus, the French Prime Minister set to hold his final meetings with opposition parties before Monday's confidence vote. We're going to discuss the market impact later in the programme. So stay with us. This is Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
This is going to get Wall Street's attention.
They're not going out and hiring a ton, but they're also not firing. So basically, you have a frozen labor market.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
Financial conditions versus economic conditions. There's a key distinction to make.
And that really is the key question for policy going forward.
The August Jobs Report. Friday on Bloomberg. Context changes everything.
Welcome back to Bloomberg Daybreak Europe. To geopolitics now. European leaders expressing concern that Russia will mount a new offensive on Ukraine as they discuss security guarantees for the country with President Volodymyr Zelenskiy. Now, this comes as Russian President Vladimir Putin says that Zelensky should meet him in Moscow.
It's a path to nowhere to meet with the current head of administration, to put it carefully. It's possible. I never rejected it. If this meeting is well prepared and will lead to some positive possible results. Donald asked me if it is possible to hold such a meeting. I said yes, it is possible. If Zelensky is ready, he should come to Moscow and the meeting will take place.
Our Europe correspondent Oliver Crook has the latest. Ollie, I don't know what you made of that. Surely Zelensky would never set foot in Russia.
Yeah, I mean, it's a lot to unpack from that statement from Vladimir Putin. I mean, you know, this is somebody who, from the first days of the war, when there were reports of basically hit squads going around Kyiv trying to find Zelensky and kill him that were eventually neutralized by the Ukrainians, it's very hard to imagine Zelensky putting himself into a position to go to Moscow, particularly when Putin says in the same breath that basically nothing can be achieved in a conversation with this administration within Ukraine. That being said, we've seen basically the new Zelensky tactic ever since the catastrophic Oval Office visit, which is that basically whenever Trump says jump, he says how high and then goes even further. You'll remember there were these discussions about a potential meeting in Turkey. Basically, Zelensky immediately got on the plane and said, listen, I'm here in Turkey. I'm ready to meet Putin. So, you know, maybe in the sort of showmanship of Zelensky, it's something that he would consider, but it's very, very hard to imagine such a thing. But again, the main audience here is Donald Trump, and the question about whether or not Donald Trump sees there being any progress here with Russia and how he feels about Vladimir Putin at the moment, which is what he was asked yesterday in a press conference. Have a listen to what Trump had to say about his message to Vladimir Putin.
I have no message to President Putin. He knows where I stand, and he'll make a decision one way or the other. Whatever his decision is, we'll either be happy about it or unhappy, and if we're unhappy about it, you'll see things happen.
And we can say that there's already some unhappiness that has been displayed by the Trump administration in the form of the 50% tariffs that have been put on India for continuing to buy Russian crude. Trump indicated yesterday that this was only phase one of what a 2 to 3 phase process could be in ramping up the pressure potentially on Russia. That being said, we're reaching this moment here in the context of Russia where Putin is really being embraced on many places in the global stage. You saw him in China. You saw him at that military parade embracing Kim Jong-un. A few days earlier, holding hands with Modi. All of this we know that Trump is observing from the White House and from the Oval Office and trying to determine whether or not, as the Europeans think, Putin is just playing games and he's not being serious about advancing any peace process in Ukraine.
Yeah, who could forget the handhold moment? And Trump also kind of bristling when asked about why he hadn't put more pressure on Putin since the Alaska summit. But meanwhile, we've got this coalition of the willing meeting happening between European leaders today. What should we expect from that, Ollie?
Yeah, so that's being chaired by Emmanuel Macron and Keir Starmer in Paris, and this is the sort of broad coalition of European nations that are basically trying to work out what the day after looks like in Ukraine. There's part of it which is trying to put more pressure on Russia, but it is this idea of the boots on the ground and the backstop force that could potentially be within Ukraine to basically guarantee that there is no further incursion on by the Russians on Ukraine in the event of a peace negotiation. The question is, what is this coalition of the willing to do? We have not yet had the contours of what a peacekeeping force would look like, who would participate in it, what its actual function is. But these are the things that are going to be discussed further today in Paris. That being said, Lizzie, all of these questions about what a peacekeeping force are completely irrelevant if there is no peace and if there is no advancement towards peace, which is why they're going to try also to get Donald Trump on the phone, as they did at the last one of these meetings a few months ago, to try to strategize and see if they can get him on board and speaking in the same voice with the Europeans.
Well, yeah, we already had President Trump meeting the Polish president yesterday in Washington. Of course, he's a populist, the Polish president, as well. Was their conversation, Ollie, a good omen for a potentially US-backed security backstop for Ukraine?
Yeah, Lizzie, what was really interesting about this discussion between Donald Trump and the new Polish president, and just to remind everybody, this is a sort of right-wing candidate that sort of surprisingly won the Polish election, really out of step with Donald Tusk and the sort of pro-European government that he is running. But it's sort of a mixed blessing for the Europeans. As unhappy as they may be about Karol Nawrocki being president of Poland, he's very aligned with Donald Trump. And what he got from Donald Trump is something that cannot be sort of undervalued, which is the idea that Trump said he's actually willing not only to not take any of the U.S. troops out of Poland. There are 10,000 U.S. troops stationed in Poland. He's willing to deploy more troops to Poland from the United States if the Polish would want that. And that is key, Lizzie, because in the next couple of months, the United States is going to do a strategic review of their military global presence. The fear for the Europeans, which is why you've seen so much pressure from NATO on getting that spending up, is that they're going to detract and pull forces out of Europe. There are about 85,000 U.S. troops across Europe, 40,000 of those in and Germany. And what Trump said yesterday is that though we may be moving troops from other places, we're actually willing to commit more troops to Poland, and that is going to be something that's very welcome from the Polish and the European community as well.
Yeah, Nawrocki may be a bridge to Washington like Italy's Meloni, perhaps. Ollie Crook, thank you so much for all of those latest news lines. We thank you. But coming up on the programme, we're going to turn to tech next. Bloomberg learning that Apple is planning to create an AI-powered web search tool for Siri to rival OpenAI. That's next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe, 6:24 a.m. here in London. Now, Apple shares jumping the most in a month. That's after we reported that the tech giant's planning to launch its own AI-powered web search tool next year. It'll be integrated into the Siri voice assistant, and it would aim to compete with OpenAI and Perplexity AI. For more, Annabelle Drewlers, host of Bloomberg Tech Asia, joins us from Hong Kong. Morning, Annabelle. Just walk us through what this new system offers. How is it different to ChatGPT, for example?
I think actually it's probably considered, or what Apple really wants is for it to be kind of similar to ChatGPT in a way. I mean, Apple as a company, if you think about it, they've been very behind on integrating generative AI into their products, and so they really need to play catch up here. The new system, so it's about to be integrated or will be integrated into the Siri voice assistant. So known internally as world knowledge answers, I think that sort of gives you a clue. But the idea is that the things that you might ask ChatGPT or Claude, for instance, you could ask Siri instead. And so this is planned to be multimodal, whether it's text, photo, video, local points of interest. There's also going to be a summarization system so you can get things to be more quickly digestible. But I mean, the idea is that Siri, it's something that's been around since 2011. It was considered groundbreaking at that time. But today, it really can't go beyond answering basic questions like, what's the weather? Apple needs to be able to do more with this and get to a place as well where it can be seen as a leader.
Tell me about it. I don't know about you, but it just does not understand my accent. Annabelle, where's the underlying tech going to come from to power it?
Yeah, it's going to come from Alphabet. So well, that's what we're hearing from sources. But Google and Apple have a long-standing partnership when it comes to internet search. And so what we heard from sources is that they've now actually reached a formal agreement this week where Apple's going to be able to evaluate what a Google-developed AI system for Siri would look like. I think the timing of this is quite interesting as well, because yesterday we were speaking about how there was a ruling from the US, a judge there that said that Apple can maintain an agreement that makes Google the default search on its engine, or default search engine rather, on its devices. But Apple during that trial actually testified to say they're seeing less Google searches than before, which again puts that pressure on. They need to be able to get that AI system in place quickly.
And we know that Apple's first choice wasn't Google, Annabelle. Why did Apple go with Google, though, in the end?
Yeah, this is interesting. So what we actually understood from sources is that Anthropic was the initial first choice, and that's because Apple did some internal calculations or evaluations, and they found that Claude, which is from Anthropic, was more ahead of Gemini, which is Google's answer instead. And so Anthropic was perhaps the front runner. But it came down to price because Anthropic apparently was asking for $1.5 billion a year. Google, it seems, was a little bit more open to more favourable financial terms.
OK. Our Asia Tech correspondent Annabelle Drewlers, also host of Bloomberg Tech Asia. We thank you so much for walking us through that. And coming up on the programme, we're 4 days ahead of French Prime Minister François Bayrou's confidence vote. So we're going to look at the impact of the political crisis on the markets. That's next. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Verdon in London, and these are the stories that set your agenda. Stocks and bonds gain after weaker than expected US jobs data cements bets on a Fed rate cut later this month. But a sell-off in China intensifies on reports of a crackdown on stock market speculation. Elsewhere, Ukraine's president joins European leaders in Paris as Vladimir Putin says that a meeting with Volodymyr Zelenskiy should take place in Moscow. Plus, Apple shares jumped the most in a month after we report that it's planning its own AI-powered web search to be launched next year. Well, if you're just joining us, a very good morning to you. We had bad news yesterday for the US economy, but it proved good news for these markets. The prelude to payrolls, of course, the US JOLTS data, prompting traders, as I say, to ramp up Fed bets, and stocks and bonds rising off the back. So you can see Asian equities now following suit, up 0.2% on the MSCI Asia-Pacific Index, but paring some of their gains as the Chinese sell-off deepens. Now, you've also got futures pointing higher, a touch higher. These are small moves on both sides of the Atlantic. But flip the board over to the cross-asset picture, and you can see in the yields picture, the 30-year Treasury yield now at 489.78. The pound at 134. We had a hawkish BOE governor yesterday, Andrew Bailey, as we were hearing from Kit Rees, but the pound paring some of its gains now. Oil at $67 a barrel. It's the second day of losses on these worries that OPEC Plus could boost supply again. And we have gold there holding near a record high on all of this Fed cut optimism. And Goldman saying that it could drop to the low 50s next year on the global surplus. That is for oil at $67 a barrel, but gold could drop to the low 50s next year on the global surplus. Now, let's get to the French politics. Prime Minister François Bayrou saying that he remains open to alternative budget proposals as long as the overall deficit reduction target remains in place. Now, Bayrou has called a parliamentary vote of confidence for Monday, and the opposition parties are holding a combined majority of seats in the National Assembly, saying that they plan to vote against the motion, which would force Bayrou's resignation. For more, we're joined now by Thushka Maharaj, who's managing director and senior global strategist over at JPMorgan Asset Management. And it's such a pleasure to have you with me this morning. So thank you so much for making time. What happens after Monday's no confidence vote? The polymarket odds suggest that Bayrou, frankly, is toast. But where does it leave the fiscal situation? Inevitably, Thushka, are we going to see a wider deficit?
Good morning, and thank you. Thank you for having me on. I do agree with your point that we are unlikely to see resolution after Monday. Our central forecast is for ongoing uncertainty and a three-way kind of split in Parliament, preventing significant change in the near term. But I would say that the overall direction is towards gradual deficit reduction in France. I'd say two other key points to make here. One, we still expect the deficit to remain high relative to other European countries. But secondly, this is not just a French phenomenon. We're seeing global concerns on fiscal debt, whether it's the US, whether it's Europe, and even the UK, as you mentioned earlier. And so France isn't special in this case.
Yeah, is the French situation worse than the UK, would you say? Is France the new Italy?
I would say that France definitely, compared to Italy, has more room to consolidate its deficit. So I think that's very fair. But if you look at total assets held by the French government, they are over 50%, and that is better than other European countries. Overall, when we look across the UK, the French, France, as well as Italy, debt levels are high across the board. It's now about willingness or confidence by investors on the ability for these governments to consolidate. Ultimately, we expect that growth improves in the euro area, growth improves in the UK, and that helps reduce deficits. But that's not an active form of consolidation, right? That will take more time. So you asked at the start, like, what happens post-Monday? We still expect the deficit target to be around 5%. I think the original proposal was a bit more aggressive, but ultimately we are going to end up with a plan to reduce the deficit over a gradual period of time. What has been reassuring for us from a market perspective is we've not seen this contagion of the French political risk into the wider European bond markets. And A, that is because we see this as being focused to France, but B, the growth outlook in the euro area is likely to improve next year. And I think the market is putting some confidence in that too.
But Thushka, let's play out some other scenarios here. What if President Emmanuel Macron calls snap elections and resigns? We've got the oats bund spread having closed yesterday about 80 basis points, 80 exactly. Where would it go to if he did that?
I think having snap elections would force spreads back to where they were in the summer and autumn of last year, which is closer to 90 to 100 basis points. It possibly could cross that 100 basis point level, but I think a resignation of the current prime minister is more likely. It's not likely that you will see a change in the president at this point. But for us, on a medium-term basis, we do see value in European fixed income, including France, I would argue, despite this political risk. We have the ECB having cut rates, we have this improvement in the growth outlook, and overall growth in the euro area closer to trend does make us more positive. I would say more so in Italy and Spain than in France at this point in time. But we do see value being created in this political uncertainty.
But what sort of spread would be required for a major loss of investor confidence in oats? Would it be 100 basis points? What level would it take for the ECB to step in and intervene?
Yeah, I think it's very unlikely that the ECB steps in with the TPI or the transmission protection instruments. I think that's a very low probability event. A, because this can be dealt with in France. B, this is it won't be spread level in isolation dependent. That is not going to be the main determinant of whether we have intervention. But to your point, when can we lose investor confidence? I think it's the volatility, that's ongoing volatility, irrespective of what happens in the next few months. Spreads continue widening. I think that would be a concern. We've already seen de-risking by international investors of French bonds, and that hasn't created this mass widening in French spreads. So, A, we've been here before. B, when we look at the forward outlook, we see a brightening picture, but volatility is likely to continue.
Well, in that spirit, we've got the next major rating agency announcement coming from Fitch. It's on Friday, next Friday. Are they going to downgrade again when, they've already got France on negative?
Yeah, I think that is a risk event. The market's well aware of it. The spreads, as you've said, they've already repriced. So we've seen the market pricing in the deficit concern. But in terms of the actions that are likely to come out at the end of this week, we would say that would be more a repetition of what they've said thus far, waiting for that clarity post the vote. But I think Fitch has already built into their expectations that we are unlikely to see a resolution on the government in the next few months. But I think the crucial point for French ratings is, are we going from a 5.4% deficit to a 5% deficit and thereafter further consolidation, or are we going from a 5.4% deficit today to something wider? And I think that is a very different calculus for rating agencies. We're more in the camp that you will see gradual consolidation.
All right, really great to get your insights this morning. Thushka Maharaj, appreciate you getting up early for me. Managing Director and Senior Global Strategist over at JPMorgan Asset Management. Good to see you. Well, I want to zoom out a bit here and dive more deeply into the bond space, because there was a reprieve, as we say, for Treasuries yesterday after that jobs data stateside prompted traders to add to their bets on at least 2 Fed cuts this year. But over the past year, long-end yields have continued to move higher. And Jamie Rush from Bloomberg Economics argues that those higher long-end bond yields are here to stay. Jamie's here with us now. Jamie, just tell us more about your call.
Well, so I think that we're thinking more about the longer-term view. Right? So right now, with sticky inflation, with wide budget deficits, with long-term public finances firmly in mind, it's clear to see that there's lots of action at the very long end of the curve, and of course that's being compounded and intensified by idiosyncratic factors like we just heard about in France, like in Japan, and of course in the UK. So I think there are some exceptions to the rule, and this is going to, and they're obviously suffering a lot at the moment. But I think if we take a step back and we think about, well, what are the structural forces that drive interest rates? Well, it comes down to the balance between global saving and global investment. And I think, a lot of the forces that helped to push interest rates down over the past 30, 40 years are starting to wane. And a lot of the ones that are kind of helping to kind of stimulate investment, well, they're helping to push up. So our view is that, yes, interest rates are likely to stay higher even as the Fed continues to cut. So I think 10-year Treasuries in particular are likely to stay high.
Well, yeah, because in the short term, you could argue that we're in danger of conflating what for French bonds is a fiscal story and for US Treasuries is a Fed story. But your argument, I take it, is that all roads point in the same direction, higher yields.
Yeah, I mean, if you look across the globe and you look at sort of a slightly earlier maturity, so say 10-year, I mean, the pattern is basically the same. And even in the 30 years, the pattern is basically every country has been hit, with the exception of those who are extremely fiscally prudent, like Switzerland. So yeah, there is an underlying force here. And if you want to dig into some of those drivers, well, you can think about what was the cause of falling interest rates and examine whether they're going to go forward. So thinking about demographics, you had the baby boomer generation socking away their paychecks into their savings. Well, now they're starting to retire and they're going to be pulling those savings out. Less savings, higher interest rates. You can think about AI, the capital intensity of AI. Everyone's rushing to invest in it. Well, that's just creating extra competition for funds. Governments are no longer able to access those funds with the same at the same price. And clearly, again, that's another reason why interest rates are going up. And that's before you even get to some of the bigger questions about geopolitics. So think about defense spending, it's going up. If you think about the rift between China and the US, well, that's not going away. So there are a number of factors, we think, which are likely to steer interest rates higher.
And so, Jamie, you've been writing about this in your new book, The Price of Money. You've written it with your colleagues Tom Orlick and Stephanie Flanders. And you say that 4.5% 10-year Treasury yields is the new normal. But how much higher, actually, with all of those factors in mind, could it go?
Well, I think it's, I mean, if you think about the risks, I guess the big ones are that governments just completely fail to get on top of their deficits. I mean, we've seen no appetite across the House in the US to tackle the deficit whatsoever. We're seeing the problems here of having fractured politics, which mean you can't get on top of the deficit here either in France or in the UK, perhaps. So clearly debt is a major factor. Defence spending is another one. We know that we used to think we lived in a safe world. We don't live in a safe world. Investment in military equipment is going to have to go up. It's going to cost money. It's going to push up interest rates. And again, we're not going to talk about AI, the kind of promise of this frontier technology. Well, if it really lives up to expectation, there's going to be a lot of money spent on stuff to accommodate it. So I think if you think about adding those three things together, then getting to Treasury yields of 5.5% and above is possible. I mean, a lot of things have to happen for that to play out. But the general direction of travel, given the risks around those three things, is basically northward. And so that's the conclusion of the book.
All right, 421.48 is where we are right now, though. Jamie Rush, thank you so much, our Director of Global Economics at Bloomberg Economics. The Price of Money published next month, and Jamie, you can pop my copy on my desk. Now, to some other stories making news this morning. President Trump is asking the Supreme Court to uphold his global tariffs in a fast-track case that could reshape trade policy. According to filings reviewed by Bloomberg, the appeal calls for putting the case on a highly expedited schedule, with arguments in early November. It follows a federal appeals court decision that said Trump can't impose wide-scale import taxes by invoking a 1977 law that was designed to address national emergencies. Elsewhere, Eric Trump's stake in a crypto company created this year is now worth about $548 million. It's one of the most striking examples of how the First family is profiting from the digital asset industry. In a Bloomberg interview, the US president's second eldest son spoke about his stake in American Bitcoin. And we also will be talking more about the Excuse me. And coming up on the programme, how the downturn in London's luxury property market has proved costly for billionaire John Caldwell. We'll bring you all the details next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now to some other stories making news this morning. An iconic tram in the Portuguese capital, Lisbon, has derailed, killing at least 15 people. Local media say that the cable that supports the tram car snapped, sending it crashing into a building. 18 other people were injured in the accident, and the tram is popular with tourists. It was classified as a national monument more than 2 decades ago. Elsewhere, Banco Monte dei Paschi has paved the way for it to take control of its rival MedioBanca. That's after it broke through the minimum acceptance level that it set for its plan to buy the Milan-based investment bank. Investors have tendered 38.5% of MedioBanca's shares, above the 35% threshold set by Monte Paschi to trigger an obligation for it to buy the shares. And luxury car maker Porsche will drop out of Germany's DAX later this month after less than 3 years in the benchmark stock index. The company has lowered its outlook 3 times this year as it grapples with US tariffs, weak sales in China and limited demand for electric vehicles. And a year after losing its spot in Britain's blue-chip benchmark, Burberry is bouncing back into the UK's stock market elite. Index compiler FTSE Russell says that the luxury goods firm, best known for its tartan-plaid trench coats, will rejoin the FTSE 100 index later this month. Metal and Energy and Metals joins Burberry in being promoted. Well, looks like you can have an aftermath after a checkered past. But let's stay in the UK now. 14 years ago, billionaire John Caldwell made what was sure to be a surefire bet, or so it looked like, splashing out on a £143 million car park on a prime lot in ritzy Mayfair in a plan to build a luxury apartment block. But the entrepreneur's lofty ambitions are colliding now with the worst slowdown in luxury's property market since the financial crisis. And for more, let's bring in Bloomberg's Damien Shepherd, our residential real estate reporter. Damien, thanks for joining me. Just talk to me about why this project seemed initially like a surefire bet for Caldwell.
Yes, it's worth us rewinding about 15 years to when the London luxury property market was looking a lot better than it is now.
Oh, yeah.
John Caldwell had recently sold his Phones for You business, become a billionaire, and what better way to spend your money than to buy the most expensive car park in the UK? So that's what Caldwell did, and he has these plans to turn it into an apartment block with the most expensive flats potentially in the world.
It's like playing Monopoly, this.
Exactly, Lizzie. But since then, we've seen a roller coaster in the London luxury property market. What Caldwell didn't know in 2011 when he bought this car park was that the market was about to peak. Since then, we've seen all sorts of damage to London's luxury housing market, and concerningly for Caldwell, it might be about to get worse as he sees low demand for his units and a constant move of the goalposts with when the construction will actually be completed.
So why has the market gone so sour since then? I'm thinking about the departure of Russian oligarchs, I'm thinking about non-doms.
There's so many reasons, Lizzie. I mean, again, if we go back a few years, about a decade ago, George Osborne brought in wealth taxes that had a massive impact on demand in the London market. Post-GFC, interest rates were so low that borrowing was easy for these ultra-rich potential residents of the UK that came over and splashed out on luxury residential. And if you look even more recently, hikes to stamp duty under the Labour government, the end of the non-dom regime. You've seen in the last month the government kite-flying ideas around new taxes for the wealthy when they're selling their homes, potential changes to capital gains tax too. All of this creates uncertainty, and that is the one thing that the market hates. That's why we're seeing such low demand for these units, and that's why Caldwell's got a bit of a headache at the moment. OK,
so really helpful background. Bringing it up to the present, why? What are brokers' views on why One Mayfair isn't getting that strong demand then?
So, look, brokers are telling me that Caldwell is pricing the apartments too high. Now, this isn't just an issue for Caudwell. There's this huge gap in the London market between buyer and seller expectations. All of the things I've just said to you about the market coming down. The problem for people who own these properties or are developing these properties is that they're struggling to come to terms with the fact that actually what their house used to be worth or what they wanted their new build apartments to be worth isn't actually realistic. So the brokers are telling me that the pricing is, not at the level it should be to attract the demand for the units. So that's the primary issue there, and that's a big issue for Caudwell. He needs to break even on this project. So obviously for him, the pricing is crucial. Right now, what I'm being told is it's too high.
I think you share my favourite hobby in looking at properties online in your spare time, and that is definitely my observation, a big gap between what sellers want and what properties are actually worth. Bloomberg's residential real estate reporter Damien Shepherd, we thank you so much for that story. We've got plenty more coming up, so stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, in our final few minutes here, I just want to set you up with some terminal charts for your trading day. We've got Broadcom earnings coming out, and they're trading at a premium to NVIDIA, outperforming on a year-to-date basis. Just something to keep in mind. Also, traders cashing in on the gold rally. Flip the board over. This is, of course, fueled by the Fed cut optimism, and we're going to get another read on whether that's justified later on today, because flip the board one more time. We've got jobless claims data coming ahead of the payrolls tomorrow. And you can see here continuing claims hovering near a 3-year high. Now, speaking of the Fed, stick with Bloomberg for live coverage of Fed Governor nominee Stephen Miron's Senate hearing. That's coming at 3 p.m. London time. But before that, we're going to have an interview with the CEO of Standard Bank. He'll be on the opening trade at 7:45 a.m. London time. But that does it for Daybreak Europe. The opening trade is coming up next. Guy, Tom and Valerie are going to take you all the way to the start of the European cash session. I'll be back at 9 a.m. with the Pulse. And we are looking at futures currently pointing higher on both sides of the Atlantic. Stay with us. This is Bloomberg.